It doesn't surprise me that you said it, having followed you for a while. It mirrors exactly what the world's greatest investors say.
Yeah.
Ray Dalio, Steve Schwartzman, and others. It's all about risk management, managing the downside. Because if they can do that long enough,
Yep.
the averages play out. We have Mr. Jay Scott. He is an entrepreneur, investor, advisor, author, partner at Bar Down Investments. And in the last 13 years, he has been involved in over $100 million in investment properties across the nation. He is the author of 4 Bigger Pockets books on real estate investing, including the best-selling book on flipping houses. You know, I'm missing the signature. I don't have the signature.
You also have the 2013 edition. We need to get you the newest edition of that.
Man, I do. But look, I pulled this out of the shelf just for this. You know, I've got some highlights and footnotes in here. I probably read it right when I got it, and it's been a while. But that book is really helpful. You know, as Jamie and I were really growing our business. At the time, I still had a full-time job, so appreciate the wisdom there.
Well, I appreciate the kind words.
So, you got a lot of experience in this industry. What should passive investors look for when they're considering their first multifamily syndication?
Yeah, so I think all the 3 previous guests all hit on really important topics. And so I probably would have said all the things they said if I were to go first. But I'll touch on something that I think is top of mind for a lot of investors, but they don't necessarily think about it from an analytical perspective before going into deals, and that's risk. So we all have different risk profiles. We all have different ideas of how much risk we're willing and able and desire to put into deals, but we don't always think about it from an analytical standpoint, how much risk is there in the deals that we're considering. So my best advice right now to investors is to start thinking about risk a little bit differently. Don't necessarily base your risk assessment off of an offering presentation or talking to a syndicator over the phone. Look at some of the more analytical pieces of the deal. So number 1, asset class. So syndication, it can be done across any asset class. As we know, a lot of us are doing multifamily syndication, but there are also single family syndicators out there, people syndicating office space and retail. If anybody's out there investing in businesses, either VC or angel investments, that's syndication as well. So we can basically syndicate anything. Different asset classes are going to have different levels of risk. So these days, if somebody is syndicating, let's say, converting a mall to apartments, that's going to be a higher risk investment than somebody that's doing a stabilized multifamily syndication. That's going to be a different risk profile than single family houses. And so definitely think about the asset class that you're investing in to give you an idea of where the risk lies. Look at what the likely trajectory of that particular asset class. Right now, I think industrial, flex space, multifamily are very low risk over the next 5 or 10 years. If you were to ask me to invest in a retail project or a single family development project or a retail project, I'd probably consider the risk a good bit higher because those asset classes are likely to be more risky. So the first thing you need to ask yourself is, what's the asset class? The next thing you want to look at is, what's the exit strategy? And we talk about 3 kind of most common exit strategies in the syndication business. You either have the development project, which is ground up, and your exit is either after you've entitled the land or built on the land, you sell. The next most common, or the next in the list, is value add, where you basically take an existing property and you improve it. Either you improve it functionally from a physical standpoint, or you improve the management to increase the value. And then third is basically syndicating a completely stabilized property, something that's just fully renovated, just kicking off cash flow every month for however many years. 3 very good exit strategies, but they come with different levels of risk. I think it shouldn't surprise anybody that if you buy into a stabilized asset, let's say you buy a share of a skyscraper in New York, your risk is probably going to be a good bit lower than somebody that's developing land in some emerging market from scratch. So always look at the exit strategy that the syndicator is employing, and consider that certain exit strategies like development are going to be a higher risk than other exit strategies like value add or a stabilized asset. Number three, always take a look at the ROI. So we tend to like deals that have higher returns, but we ignore the fact that higher returns are correlated to higher risks. There's a truism in investing, and that's that risk is, by definition, defined by the return. The higher the return, the higher the risk in the project. If an investor can offer a low risk return, people are going to be willing to pay be willing to invest for very small returns. And so the higher the return, the higher the risk. If you see a deal that's offering you 20, 25, 30%, not necessarily a bad deal, but most likely it's going to be a higher risk than a deal that's offering you 15 or 16 or 18% returns.
And risk in that sense isn't necessarily, it doesn't have to be the deal. It could be the operator.
100%. Yeah. So
like a brand new operator is probably going to have to give up more of the pie to mitigate that risk, right?
Absolutely. If some big name operator who's been in this business for 30 years goes to syndicate the exact same deal that I'm syndicating, they're probably going to command a lower return because they've built up trust, they've built up a reputation, and by definition, it's lower risk because they have been doing this longer and are probably better at it. Likewise, if I were doing it and somebody that's brand new to syndication were doing this, I could command a lower return than they could. So absolutely, the trust and the experience of the team goes a long way towards defining the risk of the project overall. But generally speaking,
everything you just said, sorry to interrupt, but everything you just said, it doesn't surprise me that you said it, having followed you for a while. It mirrors exactly what the world's greatest investors say. Ray Dalio, Steve Schwartzman, and others. It's all about risk management, managing the downside. Because if they can do that long enough, the averages play out.
Yep. Now, keep in mind, we're all in a different place. If I were 21 again and I was looking to just build up enough cash that I could become an accredited investor and have access to all these alternative investments that you don't get unless you have $1 million net worth, I'm probably going to be willing to take more risks than I am here today at 50 years old and thinking, okay, if I lose everything tomorrow, do I have enough time to build it back before I die? And so my risk profile, my risk tolerance today is a lot different than it was then. I also had a job when I was 20, 25, 30 years old. And now I have 2 kids, a wife, and no steady income. So it's a very different risk profile for different people. And everybody needs to ask themselves what their personal risk profile is and make sure that the investment that they pursue matches that risk profile.
This will be hard to do because we only have 2 minutes left. What, at least some quick 1, 2, 3 things that passive investors can do to determine that risk level and whether it meets their personal, risk criteria.
And so certainly, again, look at the asset class, the exit strategy, and the ROI. Also look at the time period of the investment. Typically longer investments tend to be lower risk than shorter investments. And that's simply because the market can crush us in the next 6 months.
Actually, let's know, we got 60 seconds. I want to hone in on that. It was a story, I heard a guy lost a deal because he was using agency debt. Someone else was able to come in and use bridge financing, get a higher loan to value, which made them able to pay more for it. But there's certain risk with that because bridge financing, they don't know the interest rate that they're going to get in 3 years or 2 years or whenever. So if we can hone in on that for like the next 30 seconds, how should passive investors look at that type of capital stack and how they're using the financing to help them determine the risk? Because it's not bad. Bridge isn't bad, but it comes with risk.
Yeah, these are the mechanics of the deal. And so definitely when you go into an investment, ask what's the financing? Is it bridge? Is it 3-year, 5-year? Or is it agency debt, 10-year? Is it a loan assumption? If there's a loan assumption, well, how long is is left on the loan? Is it IO for some period, interest only for some period of time before it becomes fully amortized? Is it amortized over 30 years or 20 years? These are all things that go towards the risk of the project. At the same time, I always want to see, if an operator tells me we're out of this deal in 3 to 5 years, I still want to see the pro forma. I want to see the underwriting for 8 or 10 years, because if the market gets crushed 2 years from now and we're in a downturn for the next 5 years, we're probably not selling at that point. If we have to sell, we're screwed. So I want to see tell me what happens if we can't sell
100%,
in 3 to 5 years.
And I've been saying that too. I've been telling folks, look, we're underwriting between 7 and 10 years, because you play it long, like it should be okay. But in any case, hey, but we're short on time. All I gotta do is don't send me the new book. I want to keep the OG. When and if you make an NFT of the original one, just let me know.
There you go.
All right. Thanks. Take care.
Thanks, Chris.